All right, Chapter 17 is a really important chapter. It is regarding how companies have to account for income taxes. Learning Objective 1 does a great job of kind of outlining the entire process and talking about why accounting for income taxes is so complex. So I would strongly recommend that you read through Learning Objective 1. It's not very long. It tees up an example that the whole chapter is going to be based on. So read through that. But basically, the tax provision is what has to be prepared in order for a company to account for its income taxes in its financial statements, and it consists of a couple different components. Uh, the first thing is a company has to report what it thinks its current income tax liability will be. That is, its tax liability this year, relating to its profit that it generated this year. So, as part of that process, a company will record either an income tax expense or actually a benefit, depending on what it expects to owe the government or what it expects to get back from the IRS. You can have tax losses that can generate current refunds of tax dollars paid previously. So sometimes you can have tax benefits. So, what a company expects to pay this year or get back this year will be this year's income tax expense or benefit, and there will be a correlating income tax payable or receivable on the balance sheet regarding this year. The second thing that a provision does is it makes you record in the current year any future impact on income taxes because of something that happens this year. All right, and those are called deferred tax liabilities or deferred tax assets. And we'll get into discussing those more as the chapter goes on. But um, these things arise because of the thing we looked at last chapter called timing differences or temporary differences. If you have a temporary difference like depreciation, for instance, that causes you to pay less tax this year because there's accelerated depreciation, then that means you're going to have to pay more tax in a future year because that temporary difference will reverse as soon as tax depreciation is less than book depreciation. So when that difference reverses, your tax liability will be more than it is in the current year. So that will cause us to have to record some deferred tax expense and a corresponding deferred tax liability. All right, deferred tax assets are just the reverse. If you pay more tax this year because of a timing difference, but you're going to pay less because of the reversal of that timing difference in the future, that means you get to record a deferred tax asset and a correlating deferred tax benefit, opposite of expense, in the current year. Okay, so read through Learning Objective 1. It gives you a lot of kind of background information and really kind of just tees up the whole process, puts more into detail what I just said, shows you this example that's going to be the starting point of this entire chapter's examples. This PCC company will be the framework for showing you all the examples. This is a balance sheet that they have for 2009. We'll see this exhibit 17.2 will be an important exhibit when you get into looking at deferred tax assets and liabilities. We keep track of those differences, those temporary differences, year to year because they originate and then they reverse over time. So we have to keep track of their balances, and this is kind of a starting point for keeping track of those deferred tax assets and deferred tax liabilities for this particular company. The income tax provision process is outlined right here. The total tax provision means what's the total income tax expense or benefit for the current tax filing period. And the total equals whatever the current amount that you expect to owe or get back, plus the deferred income tax expense or benefit that you have to record this year that's going to relate to future changes in your tax liability because of what happened this year. So it's the sum of those two, and you go through these steps to get it. The first step is finding all your permanent differences, identify the temporary differences. We're going to calculate our current tax expense or benefit is the first thing we're going to calculate, and then we're going to move on to looking at our deferred tax asset or liability.